I'm excited about this conversation for a number of reasons. One, from a personal level, I've worked in sort of these spaces where catalytic philanthropy, though I don't think we always had that term as sort of like something that we applied, but it's always been something that's been quite effective and useful in my career and quite essential. Although I guess we'll talk a little bit about whether or not it's effective in all cases. So I'm really excited to have this conversation. I think it's a conversation that's quite necessary, particularly as we've been having a lot of dialogue throughout the last couple of days about how do you engage philanthropy, how do you utilize different types of strategies and models that can really get capital off the sidelines in different types of ways. And so looking forward to this conversation. I will actually have our panelists introduce themselves because I don't think I can do it justice, how phenomenal this panel is. These are folks that I've admired for quite some time, and I think these are folks that you've also admired and have probably done some collaboration with as well. And so I want to start with Morgan, if you could just share a bit about yourself.
Sure. My name is Morgan Simon. I'm a founding partner at Candide Group, and we work with families and foundations that want their money working for justice. And we do this by predominantly building custom portfolios of private investments, both funds and directs. We've supported about 140 companies, like 285 million. And we also have 2 private debt funds, Afterglow, that's a climate justice fund, and Olamina, that focuses on U.S. community development.
Hi, everyone. My name is Laura Metcalf. I'm the Chief Portfolio Officer at Draper Richards Kaplan Foundation, or DRK Foundation. And we've been around for 23 years now, supporting the most amazing social entrepreneurs across the globe. We work in the U.S., Sub-Saharan Africa, India, and most recently have expanded to the EU and UK. And what we really believe in is the power of individuals and individuals working together to drive change, to make positive impact on people's lives that eventually leads to systemic change because you have credibility and experience and kind of know how to fix systems. And so over the last 22 years, we've supported about 250 organizations. For the first 15 years or so, it was all nonprofits. And in the last 6 or 7 years, we've expanded to also supporting mission-driven for-profits. And our organizations over that period of time have positively impacted the lives of 400 million people.
Hi, I'm Komal Sahu. I serve as the Chief of Sustainable Finance at AVPN. AVPN is a funders network headquartered out of Singapore. We're a 13-year-old organization. We primarily started out as a philanthropy-focused organization, but we now work across the continuum of capital, including themes such as blended finance as well as impact investing. More recently, even focused on ESG with some of our corporate members. We're a diverse funders network, so we have some of the marquee foundations you're all familiar with, but also DFIs, impact funds, corporates, lots of financial institutions, as well as academia, a number of family offices, because Singapore is a private banking and a family office hub. Since COVID, we have raised about $40 million in philanthropic capital, and I'll talk more about that. But we've also deployed 30-odd off that 40 million, and it's been quite a journey to build that out and then to be able to deploy it as well.
Thank you. So you've already heard that these are really powerful individuals that have made a lot of impact throughout their careers. I think really importantly, they represent a lot of different perspectives in terms of institutional profiles, Morgan being an investor, a venture philanthropy that's evolved over time, and also a funder network. I think these are the types of institutions that really can make up a lot of dynamic ways and contributions in terms of catalytic philanthropy. But having said that, as I said earlier, catalytic philanthropy is not necessarily a term we've been using for a long time. It's been normalized more recently. And I think it's really important in conversations like this because we use a lot of phrases that we actually articulate the actual definition and how we are approaching these terms. And so my first question to the entire panel is actually, how do you define catalytic philanthropy?
Sure. For me, it's the ability to influence. It's the ability to corral others along, such that you your weight, your gravitas as a philanthropist carries weight with the others that come along the journey. It's the ability for you to then make sure that others also understand the themes that are important to you and are interested in the very same themes as well. But also then you open doors for them to consider and explore, and you change your own thinking around philanthropy while you do so.
So I'll be the rabble-rouser for a second and just say, shouldn't all philanthropy be catalytic? I mean, really, if it's working well. Now, I don't want to, torpedo the work of C3 and all the good work that's been done around blended capital and catalytic capital and the importance of it, because I do actually believe in it. But I do, to your point, Rodney, I feel like as a field, we tend to, when talking to each other, which we do a lot, we talk amongst ourselves, we tend to come up with these phrases that we understand, but often those who are seeking to serve don't understand. So I'll get off my pulpit, but it's just that comment I had to share.
You can stay there. It's okay.
And so the way DRK thinks about it, we're an impact first. We're a philanthropic vehicle. We're an impact first investor. And so for us, catalytic capital is capital that is willing to take risk at a time when others may not be able or willing to. It's patient. It could be return seeking, but it's going to be return seeking in a way that that honors the impact before the financial return. So I'll stop there because I'm sure Morgan will have great perspectives.
Gosh, let's hope. I'm going to go kind of broader philosophical because I think we're going to have later opportunities to get into the technical element. I started this morning with the dictionary, a great place to look at words. And the idea of catalytic really being a scientific term at the root that is an agent that makes things go faster, which is interesting in the prioritization of speed. And I think that's something oftentimes in a US cultural context, faster is not always better. And we need to be thoughtful about that in terms of when is catalytic going to be positive or negative, which connects back to a broader theme that I think we have as a sector as impact investors, right? The Merriam-Webster definition of impact, to impinge upon, especially forcefully, right? That could be good or bad. So I think we similarly need to be cautious sometimes about, is speed always a great thing, or when do you need to slow down in order to speed up? But what it really got me thinking about is the magic of science. And thinking of when I was kind of 14 and in chemistry class, which is probably the last time I was in a chemistry room, and just the miraculous nature that you could make something out of nothing, and that you could make something that hadn't existed, right? That you could will something into existence, and that being a form of power. And from that perspective, I think about the number of organizations we partner with as the mad scientist, and that we're providing that spark to be able to make the miracle happen, to make that new thing happen. And that you need, in the context of thinking about what's going to create real change in the world, systems thinkers who are willing to imagine what can seem to be impossible, right? The idea of it's impossible until it's done. And that sometimes you need that catalyst to be that spark, to make something dream its way into existence. That's where I see catalytic work happen.
No, I really appreciate that. I want to go back to you, Laura, because I think, this question that you pose, I like you staying on that soapbox. You should keep doing that. I think this is open conversation, right? And I think there's a lot of things that you've raised, all of you, and particularly Laura, what you're talking about in terms of why can't philanthropy in general be catalytic. I think that's probably a question that many people in the audience are thinking about as well. But I wanted to ask you about this question in terms of how does DRK think about leveraging philanthropy around risk and innovation, and really kind of more specifically the approaches that you take?
Sure. So where to start? So DRK, like I said, is investing in both nonprofits and for-profits. We use the same diligence process in both. At a recent retreat that I was moderating a panel a DRK retreat, I posed the question of strategic philanthropy versus trust-based philanthropy, and I definitely said strategic philanthropy is kind of where DRK sits. We love trust-based philanthropy. We're glad Mackenzie Scott is out there leading the way along with others there, but certainly we still are an organization that does very deep diligence with our portfolio because our approach is one where we're super hands-on. And because we're so hands-on, we're able to take more risk earlier because we're really embedding ourselves with the organizations. So our model's really straightforward. It hasn't changed in 20 years, which may not be great, but it seems to work, and our entrepreneurs seem to like it. So we write a check. It's not a particularly large check, $300,000. In every case, we take a board seat for 3 years. But then because we only make ever one funding decision, from that point on, we're trying to change the power dynamic that exists between grantor and grantee or investor and investee, and really be on their team. And so how does that relate back to your question? Because we want to be on the inside, really in the trenches, dealing with, we want the 10 o'clock Sunday night call when something goes wrong. We want to deal with the challenge. We want to deal with the opportunity. That allows us to take more risk and more risk earlier. And I think we're at our best when we have leaned into an organization working in, South Africa to try to employ low-income women in starting childcare centers to improve early childhood outcomes in low-income communities and settlements in South Africa, right? Where we kind of take a flyer on an organization earlier. And yet, we, like many foundations, do at times have a tendency to start to swing more into that. It's easy to get into risk aversion when you're doing the diligence process. And we do the diligence because we think it makes us more able to help once we get in and we're on the board working with the team. But there's this balance that you're always going through of when you find out the bad thing in diligence or the thing that's messy or sticky, what do you do at that point in time? And when we're at our best, we decide to lean in and help them fix it. But I think that's something that all philanthropists and foundations end up dealing with. I've been on the side of creating impact investments where I'm like, okay, wait, this organization, working with a foundation as an investor, this organization gives away money with zero chance of return, and we're crafting an impact investment here that has some potential upside, and it is going through a longer process than the grant makers go through. This frustration around how to think about risk in an investing context, even if you're an impact-first investor, I think is really important and hard, and I think we're always struggling with it in the field, and certainly even at DRK.
Yeah, I certainly can speak to that myself in terms of those challenges and struggles. I want to come back to you in a minute, Lara, but I recognize that we have Morgan here, who shared about in terms of what Candide does. There's been points and times in which I'm sure that philanthropic capital has been useful to pursuing your objectives. Can you share about how you think about the use of philanthropic capital as it pertains to your impact investments?
Sure. I think about not only how philanthropy relates to impact investments, but also the idea that impact investments themselves can be catalytic. Right? So when we think about those two frames I gave before, the idea of how do you help something speed up, and then the other of how do you sometimes slow down to speed up, to give something the time that it needs to be able to thrive. And that can often be a great role for philanthropy and for a number of emerging managers, for instance, that are starting out. So even when we started our Afterglow Climate Justice Fund, we had an initial grant from the Grove Foundation to be able to give us time to really figure out what should the strategy be, to do the deep work of listening to community, so not making assumptions about what's needed, but making sure that that's an informed process, creating a community advisory board that's able to contribute to investment decisions, right? This is work that was able to be supported through philanthropy, and then a subordinated capital layer from the MacArthur Foundation as an anchor and really supporting the growth of the work, and then finally a senior capital layer. So all three of those layers I see as catalytic. they're very different, right, in terms of what they're seeking, from a grant facility to subordinated capital to senior capital. Collectively, that's currently 48 million, that hopefully will be 75 by the close. But the idea being that you needed all of those partners to be there together at the table to make it work. So I think it's important to see, how do we partner? How do we layer? And then also, how do we think about ways that we can be catalytic with any transaction? So 2 examples I wanted to give in terms of speeding up to speed up and slowing down to speed up. How many folks in the room know about the Impact America Fund? And if you don't, you should, because they're amazing. So this is a fund that invests in early stage ventures that are supporting underserved communities in the US. And when we met the founder, Keisha Cash, about over a decade ago, and was just getting started on Fund 1, and having a lot of folks, this will be a familiar story to many people who've started an initiative of, this sounds really great, get back to me when you have your first investor. So we were able to run a very efficient and quick diligence process to make sure we could quickly get Keisha to her first yes. And that was something that Candide Group was able to do in Fund 1. And now, I'm proud to say, they're at 177 million of assets under management and on their Fund 3. So it's not always just the idea of cutting a check, but it's, are you able to do that in a way that is actively supporting other money coming in, right? And knowing that that could be philanthropy, that could be a totally traditional venture investment, but being thoughtful about what's the relationship we can have with an entrepreneur or a fund manager to make that capital catalytic.
And did you share your diligence too?
In other cases, yes, but we are, the core of our work is building custom portfolios, which means we're often making investment recommendations based on what are the particular needs of a family or foundation. So what applies as diligence in one case is not going to be the same for someone else. So I always want to make sure I'm making recommendations that are really custom to what are the needs of a particular portfolio. So neither here nor there. We're always happy to share our perspective in terms of, is this appropriate? And then the second example, just quickly, in terms of helping a group slow down to speed up, we once were working with an entrepreneur who had a really great idea, but didn't quite have the business model locked in, and came from a lot of passion for impact, but not a lot of background in financial modeling. And we were able to help facilitate a grant for them and to be able to hire a consultant to come in, support the building out of the business plan. And that was to some degree a slowing down, but that it meant that they were able to come back to the market and raise a lot more capital, a lot more efficiently, right? So they were slowed down in order to speed up, and that was a catalytic grant that then led to us and others being able to make investments and grow that company, which is still around a decade later, which is great. I'll go ahead and stop there.
No, thanks, Morgan. I think one of the things is even an example that you gave about Impact America Fund, phenomenal example. In addition to the great work that Candide was able to do, there was also other philanthropic contributions as well to sort of help things move forward. And I think one thing I think about, and even emphasizing on this, you're talking about a Black woman, first-time fund, and really I think the opportunity, as we think about this, as you've shared, the opportunity for catalytic capital to be thought of in the fact that the economic model for a first-time fund manager is not great. Particularly if you're not coming into this scenario with your own capital, friends and family wealth. We oftentimes don't think about the fact that philanthropy can play the role, particularly those who are focused on closing some of these wealth gaps and inequities, that philanthropy has to play a role to recognize that a lot of fund managers starting out already out the gate, maybe they've made an exit from the firm that they were previously working for or came away with something, they have some generational wealth to bring to the table. That doesn't work for most Black and brown and women fund managers. So I think a lot of what Morgan's sharing in terms of that context is really how do you rectify these structural dynamics as best as you can from a philanthropy perspective. So thank you for that. Como, I recognize that one, you've got this, this really several different perspectives on this and opportunities of discussion because one, you're part of a funding network, which brings its own dynamics. I'd love for you to share a bit about that, but also working in a different context. We're talking about the context that you're working in terms of Asia and like the contrast to some of the philanthropic landscape and dynamics in the US. So could you share on both accounts, actually?
For sure. Firstly, unlike my co-panelists, we're not fund managers. We are not a licensed entity. We don't act as placing agents. So we are restricted in the things that we can do because we're a network, and our network is quite diverse. On the philanthropic side, when I mentioned the 40 million that we raised, we went through a very rigorous process when we did a RFP for the organizations and not-for-profits in the region that wanted to apply for grants. And we were giving out sort of 250, 300, right up to 500 in grants because those were the mandates to get the money to where it needed to go, bearing in mind COVID was already taking place, and these nonprofits, we had to trust them. We had to use the trust-based philanthropy model. We had to be flexible to give them that operational funding that they needed, but we had strict metrics and reporting mechanisms in place, so we put those processes in place, which was important. And Asia was interesting in that regard. We really broke down silos. We had families come in, we had corporate foundations come in, we had some of the global foundations, such as the likes of people like Gates, Google.org, come along and partner with us. And a number of these, these pooled funds that we put together, we have 13 of them. And they came with deep themes: gender, climate, sustainability. And now the latest one we're doing with Google.org is a 15 million fund for AI and what the impact AI will have on marginalized communities and disintermediating them. So I think in Asia, it's families have been and the philanthropy's been very community focused. Some of it's culturally led, some of it is religiously led. So again, some of the learnings that have come from the global north is important to bring out. And the pool funds were a great way to get the conversation going that this is a way to do philanthropy. You don't need to be perfect. Perfect is often the enemy of good. And we need to get to where we need to go because these organizations, these nonprofits need the funding now. And I would say in Asia, we are seeing an evolving landscape. We are seeing families set up foundations, especially when we are going to see this huge transfer of wealth happening between the current wealth holders to the next generation. And a lot of those next generation are coming with global education. They are learning how to do things differently. And the other thing COVID taught us is we're not cocooned. We are not insular. We need to learn. We need to evolve. And whatever's happening within our families, we're not cocooned from what's happening outside. So therefore, we need to think differently with our wealth, and we need to have more impact thinking embedded in, and we're seeing that come through in the next generation. So I think philanthropy will evolve as we see that wealth transfer happening as well.
And that makes me go back to Lara, something you shared in terms of the fact that DRK principally started off purely with nonprofits, but made a transition to also supporting mission-driven enterprises. Can you actually share a bit more about what the decision points for that and how you got to that place?
Yeah, I'm happy to. And so a couple things. We've had a bunch of evolutions that occur because when you're around for as long as we have been, hopefully you're a learning organization, and that allows you to kind of thrive and change. And so I think one thing we really spend a lot of time thinking about as we're bringing organizations into the portfolio and working with them is, are you matching the right organization to the right problem and the right solution, but also do you have the right legal structure and the right capital for the right problem? And I think there's been an assumption in the past that nonprofits can't scale. And so therefore any big problem, you should look for a market-driven solution because you're going to reach scale faster. And Bridgespan had done some amazing work on this, a decade ago, that the sad number at some point was like only 50 organizations over 20 years, nonprofit organizations, had scaled to more than 50 million in revenue. I mean, it was really, and then I remember seeing a presentation, and then they would pop up discountmugs.com, which was a $50 million organization. For real. So just to make the point that really there was a scaling issue in nonprofit world. I think that has totally changed, and with some of the big bet philanthropy that we've seen come through, whether it's Audacious or Blue Meridian or a bunch that I'm going to forget, I think that all of a sudden you're seeing that nonprofits can be scalable solutions. So really when we're thinking about capital and risk and organizational structure, we're wanting to look at what are the dynamics of the problem, who are the folks that care about it, and where are the sources of capital. And so one big shift that happened for us, we came out of a venture capital background. Bill Draper, who's 95, the father of all the Draper VCs, still sits on our investment committee. He's amazing. But that's where we really came from, that venture space. And so the first decade, we were like looking for disruption. Everything was, who's disrupting? Where's the disruptor? Who's going to blow up the system? If you looked at our Africa portfolio, we had a lot of really well-intentioned white people from Silicon Valley who were bringing their tech idea to the continent. And honestly, some of them still exist and did really, really well. And other ones blew up because it's really hard as somebody from Silicon Valley to know what somebody in Botswana or Nairobi or Kenya or you name the country, what they need, right? And so I think the big shift that occurred and it kind of got reinforced for us around our 20th anniversary when we looked back at our 30 most impactful organizations over the life of the portfolio. What we found were those that did not disrupt systems, but in fact found ways to work within existing systems and infrastructure and maybe fix a friction point. They were able to have 15 times more impact at 3 times more impact at 15 times less cost. So 3 times the impact, 15 times less cost. And so what does that mean? Finding ways to work with government often or other existing systems. Like the 2 quick examples I would use, there's an organization called MUSO that does healthcare delivery in Mali. Went in there and realized that delay in care was the main reason that people were dying unnecessarily. So what they did was they built a systemic view and they embedded themselves with the Mali government by seconding the people that NGOs and philanthropy were paying for, but really worked so closely with government that now Mali has had 3 coups in the last decade. And this organization continues to go strong because they are, and have had achieved amazing early childhood and reduced mortality numbers because they embedded with the system. And so even when it topples from the top, the bureaucrats just want to keep serving the people. And so that was one. Another one I'll just say quickly is an organization called Housing Connector here in the US that realized that there are 20 million people in the US with unstable housing, 3 million unhoused. And at any given time, there are at least 3 million empty rental units in the United States. So there's a mismatch here. But often landlords are afraid to rent because of bad credit scores or bad history or whatever. And so Housing Connector had this insight of like, well, wait a second. If we could build a platform where we could match renters with landlords, but with the support of local nonprofits. They work on Zillow, if people have heard of Zillow. So Zillow lent their platform to Housing Connector basically to build this top layer, that they could actually also access some HUD grants. They could de-risk renting to these housing unstable people by connecting these groups and then also throwing in kind of a insurance product, basically, that insures some portion of the rent. So again, they looked at a system, they looked at a problem, they looked at a system, they deeply understood what was happening in the system, and then created a solution that just reduced friction. And so I think that for us has been a big evolution in our thinking.
That's really helpful. And one of the things that comes to mind to me is that to your point, like DRK started from a perspective of really seeding venture capital, like that's sort of like the DNA. And one of the things I was thinking about, Morgan, from your opening sort of comments were, not just philanthropy is catalytic, but how can impact investing be catalytic? And venture capital is one version, is innovation in terms of moving things forward. But Candide has also been able to, I'm going to use the word like sort of has helped with non-conventional structures, right? Or unconventional structures rather. And so I'm curious if you could just share a little bit more about some of those opportunities that really were able to advance impact in a type of way that more traditional or maybe forms that investors and philanthropists are more comfortable with might not have been able to do.
There's a lot of examples, which is great. I think a lot of people have been kind of sitting with this question of there are a lot of phenomenal businesses that can scale to the size that venture looks for, but can they do that in a way that's going to create equitable outcomes for communities is a live question. And I think that's where when we evaluate venture capital funds at Candide, we're looking at what are the communities that they're serving, who are the entrepreneurs that they're supporting, and then what are they doing to address the structure of VC itself, and are they finding ways to innovate to make that system itself more equitable? So we tend to really try to balance those three factors while at the same time be looking at what are other ways that if a business wants to remain at a certain size and not venture scale, but maybe is interested in becoming worker-owned, so groups like APIS and Heritage that do ESOP conversions, or the work...
Can you explain that just in case some folks aren't familiar? Sorry.
I appreciate, call us out anytime we're using acronyms and not explaining them, not a good practice. So employee stock ownership programs, which is basically a very long-standing way in the U.S. to be able to transfer ownership to workers and try to create a long-term asset for workers. So we do a lot of work on the concept of ownership writ large, and whether that's in the context of worker ownership or housing or commercial real estate, and the idea of land and liberation being very much connected in how we think about that from an investment perspective. When we get into the specifics of transactions, I think that's also where, as investors, we have a lot of opportunities to try to be more catalytic in the way that we work. So to share one example, there's a company called Navajo Power that was started on the Navajo Nation, and that is focused on building utility scale solar. And when we started to work with this company, the first thing we did was just be willing to structure the transaction. It's nice to have that last look, right, of say, oh, call me when you're on your last million and you've already, done all the legal and done all the hard stuff. And sometimes in impact investing, there's less of an incentive to lead. Compared to traditional VC or early stage, because it's not necessarily competitive rounds. There's not necessarily a first mover advantage financially. And that means that you have to be willing to stick your neck out at times, and are also in that process be able to achieve a more mission-oriented outcome. So we agreed to enter that process with Navajo Power. We decided early on that rather than opposing counsel, right, which even when you start with that frame of, I don't want to oppose you, I'm trying to support you. We actually signed an agreement with Bruce Campbell of Blue Dot Law to have mutual counsel, to map out a term sheet of saying, we want to work together to achieve this outcome. Let's put all the problems on the wall and both sit on the same side of the table. And we were able to really move things in half the time and half the cost. And we wound up then co-publishing a blog post on that, which you can find if you Google Navajo Power or Candide Group, I'm not totally sure. But essentially, we were able to say, let's try to work collaboratively on what the outcome should be, as opposed to taking a traditional practice of opposing each other. We then, in thinking about what catalytic capital was going to mean, because we were looking at doing a debt facility that if they'd gone out to traditional finance probably would have been like 10, 12%. And we were arranging a facility that would give 2%, 0 to 2% capital. Great. Well, what are you going to do with that 10% discount? right? That it's not just, let's just use cheaper capital because it's cheaper and that's good. We want to make sure that the fact that it's cheaper is actually creating better outcomes for communities. That's why we're providing this capital. So we worked with Navajo Power to create this concept of what we call the mission delta, right? The delta being the difference between the 2% and the 10%, and creating what the company has continued to call turquoise shares, which is shares in the company for Indigenous community that were financed by that difference, right? Of saying the savings that we got, that we don't have to pay traditional finance, we're going to give that to Navajo communities. And they've now created the ability for investors to be able to invest directly in those turquoise shares, to say, essentially as philanthropy, I want to buy shares that then can be in service of Indigenous communities. So that's one where we were, as investors, just trying to see from both a process perspective of agreeing to lead, sharing the memo with a number of investors, not to provide an investment recommendation, but to explain this is this kind of funky structure, and here's why we did it. And if you are interested in achieving these outcomes for communities, you're welcome to come along this ride with us, right? Let's explain how we do it. And then to be able to do it in a way that's maximizing outcomes, hopefully, for Indigenous communities was important to us. And if that sounds complicated, that's part of why some partners came forward and said, we love what you're doing, but can you make it a fund, please, so it's easier? And I think it's also important to note for folks who are looking at impact investing, the idea that you can roll up your sleeves and do that sort of work if you're excited about leading and making it happen, or you can partner with people who do and not break your brain on it. So I think there's so many different entrance points to this work, and I think that's very true with philanthropy as well. When I think about groups like Thousand Currents or Solidaire, who are able to support people through their journey of maybe you're not going to be in a position to spend hours a week investigating where can I be catalytic as a philanthropist, but other people are doing that work, and you can support them and donate alongside them. So I'll pause there.
I mean, that was great in terms of, yesterday I moderated a conversation and Astrid Schultz talked about like having that easy button to make things more simple for folks who want to participate but don't want to do the, break your brain kind of like work as well. And so, but Morgan walked through a number of things in terms of sort of, the piece around the legal components. How are we sort of deconstructing some of these sort of traditional means of working from a legal perspective? I mean, I love that. So that's one innovation. It seems like quote unquote small, but it's a significant one because oftentimes in my experience, I'm sure in everyone's experience, things can get really hung up on sort of like legal components, accounting practice, auditing practice, how do people actually perceive these sort of things. So that's one thing. But then also looking at this question around how are you actually driving additional impact by like not accepting market rate, right? And how do you distribute that economic gain in a way that can actually produce outcomes, impactful outcomes for communities? Those are all sort of very granular innovations that, to Morgan's point, a number of folks are putting into practice, right? There are a number of models for this that you can kind of look towards, and how do we get to that easy button, I think is the question for a lot of folks. So, Como, I'm thinking about like your earlier comment about, you are part of a funder network, and so you're not making allocation decisions, not able to make those sort of recommendations. But there might be folks in the room, and certainly folks I know throughout this conference, that are in positions in which they're in similar roles, where they are maybe doing some funder organizing or working to influence in some way, but don't have sort of like the direct power to like really move something forward directly. Could you just share some of the things that you're working on and how you're sort of, I don't know, not best practices, but some of the ways that you're sort of instigating, and I'm gonna say that in a loving way, some of your members to really move the kind of impact that you see?
Well, we see ourselves as field builders, as ecosystem builders, and have been doing it for over a decade. Our mission as an organization is to move capital for impact for Asia. So as a result, we think more holistically, we think more innovatively as to what we can do. Clearly, what we've managed to do with the philanthropic dollars that we raised was eye-opening even for us. It was an innovation. It was a thinking that we said, well, given what's happening in the world, perhaps we can pull on the heartstrings and do more. And as a result, what we have done is we realized that there are conversations that are happening at the global level which can also inform us. We hosted our very first Impact Investing Day at our global conference in KL, and we heard a lot of conversations around blended finance. People had heard the term, didn't understand it, wanted to do more about it. So we're bringing that same philanthropic thinking and the same philanthropic pooling towards putting together a catalytic capital allocation from a philanthropic standpoint, because we can't play a role with respect to the commercial side of the equation. But could we create a facility where we use that philanthropic dollar, take them through a journey into blended finance, take them into a journey into impact investing, showcase, create a steering committee, a very high-touch engagement for these members to showcase opportunities on projects, on ideas where they could perhaps pay for a guarantee that a DFC or an FMO is providing for first loss capital. Could there be subsidized some debt instruments which will get capital to these gender diverse MSMEs that don't have access to it? Could we be supporting climate adaptation solutions where perhaps we need to de-risk investment, and that philanthropic dollar could be used for, that facility could be used for de-risking. So we have 4 pillars within AVPN that we're focused on: climate, gender, healthcare, youth, and livelihoods. And within those pillars, we want to use this catalytic facility. And we're also thinking through impact funds themselves. Could we do something to provide technical assistance, capacity building? So all of the role that philanthropic dollars can play. And clearly, we have members who can guide us, who can advise us, and we want to be catalytic towards the work that they're doing as well.
Thanks for that. So I was actually going to ask this question as the final question I was going to propose, but in fact, this question was asked by an audience member, so I'm going to ask this to the full panel. What is the innovation in philanthropy that excites you the most? What are you most eager to see happen or shift in the philanthropy space?
I mean, I mentioned blended finance already. This is a journey for us as an organization. It's going to be a journey for our members. We clearly want to play a role, and we have members who are on the credit side of the equation. We can't do infra. Infra is too large for us, but sort of the non-infra space, and even within Singapore, the Monetary Authority of Singapore is very supportive of looking at blended finance. Energy transition is obviously the biggest conversation, but there are issues even with respect to even topics of energy transition can look at things such as access and inclusion, microgrids. Could we play a role with respect to the smaller projects where we can bring our catalytic capital, our philanthropic capital to then deploy capital into possibly these projects that exist as well?
I'll jump in here, and I mean, I have a pretty long history in impact investing. I mean, I was doing social impact bonds back in 2012, 2013 to talk about something that didn't actually reach the full potential I think we all hoped and wanted it to, although appreciate that outcomes-focused finance is still out there, and there are some organizations doing a great job with it, Make Home Capital, Social Finance, and other forms, others. But so that's why I'm thinking, I'm like, there's so many new things that come and go in philanthropy. I guess what still excites me is the big bet funding that focuses on really scaling things that have been shown to work in multiple contexts. There's so much need in the world right now, and that's I think being in a room with all of you helps me manage my anxiety about the world because there are so many people working on so many important things. So I should say thank you to all of you because you make my life better because I have less anxiety. But I think also when we can be self-reflective about what's really working and has evidence of working versus what we hope works, but we don't know if it does yet, and then really drive funding to the things that are working, I think that's really, really important. So maybe it's not that new an innovation, but I hope we see more funder collaboratives really focused on scaling things that work.
Well, whoever wrote that question, love your handwriting. It's really phenomenal. Come look at it after the panel. Two thoughts. One is there's an activist adage, which is very simple, nothing about us without us. And I think some of the innovations in philanthropy to ensure that there is more community control over how resources are allocated, some of the work of local community foundations, of really thinking through how do we make sure that we're not just telling people what they need, and also making sure that people have the ability to use philanthropy to do real organizing work, and recognizing that the role of philanthropy shouldn't be to put Band-Aids on systems, it's to change the system ultimately. And then in the context of impact investing in blended capital and the use of catalytic capital, which often can be philanthropic or PRIs, program-related investments, which is where foundations get to use part of their 5% payout requirement and do it as an investment instead. So legally, it's still counted as philanthropy. In the past, I've been in impact investing for over 20 years now. So past could be 10 years, I guess. That doing impact investing at all was considered so scary that in itself was catalytic, and that there were actually a lot of cases of very kind of traditional investments that were getting PRI designation because everyone was scared to do it. And there was actually one case of a foundation that had invested in a venture fund that intended to do investments that were, good for the world investments, and was projecting, aspiring, shall we say, to make above market returns, but the foundation classified it as a PRI because, it's new and different, right? And they had to actually declassify it later because they'd made too much money. And by the way, you absolutely can beat markets when you take people and the planet into account. I think we're all now clear on that, I hope. SOCAP24. But that was a radical statement, right, not too long ago. So I think nowadays we're seeing the idea that catalytic capital in a blended transaction needs to do things that market rate capital is not willing to do, or it's not catalytic, right? And that we need to be disciplined as a community in terms of catalytic needs to add the spark. It needs to make the miracle happen, right? If market rate capital can do it on its own, that's not miraculous, and philanthropy shouldn't be there, right? So that's where I think discipline about catalytic capital, that's what I'm excited that I actually am seeing a lot more of than we did in the past. And that's part of why, for instance, so Olamina, which is our fund focused on U.S. community development, we had started off entirely investment, and this is the first time that we now are including grants and recoverable grants as part of the structure of seeing there is more appetite to really look at how we can push forward with a blended capital stack. So that's quite exciting to us.
Can I mention one thing? This is a debate we have a lot in-house, even at DRK. And actually PRI versus MRI isn't only defined by returns. In fact, it's defined by whether it's impact first or not. But this debate that we have often is if there is enough commercial capital, does that mean we shouldn't invest, right? And there are two modes of thinking. There's one part that says, yep, they don't need us, and so therefore we should just let the commercial capital markets do their thing. The other side of the coin, though, is often the impact-driven entrepreneur, CEO, founder needs a strong voice on the board who is going to help that person, help them continue to represent impact as part of the mission, right? So it's almost like equivalent to an activist investor in the public equities context, right? And so, I mean, this debate exists in the commercial markets. I think it exists in foundations too. Is it more important to stay and be that impact voice? Or should you just leave the cap table because there's too much commercial capital? And so,
Can I respond?
Lara, I was going to add to that. I mean, clearly with us, that catalytic capital does have additionality. Some of these projects will not come into existence. Some of that commercial capital will not come to the table unless there is this philanthropic capital de-risking the commercial investors.
Yeah, because I just wanted to add and really legitimize that foundations making money is a great thing, right? That is how they fund the amazing work that they do. And similarly, we work with some families that are first-generation wealth holders where ensuring that their kids are able to pay for college and that if the point of what we're doing is that we want wealth building for all, that means that we are absolutely not opposed to making money, right? But it's the idea that we want to be clear and intellectually honest about when are we leveraging catalytic capital, when are we trying to have profit maximizing capital, can we be a voice for impact in all of those situations, and ultimately, as someone who cares about social change writ large, I want to invest in all of it, right? So it's not saying that we all need to do 100% catalytic capital. We can do all this work across different asset classes, across different flavors of capital, and just always try to infuse as much impact as we can in that conversation. So I get this is the Catalytic Philanthropy Capital room, right? It's not just something wild to say we are obviously pro catalytic investments, but noting that I think we need all of it to be part of the capital stack.
I think that's really important to note. And I'm going to take moderator privileges and answer the question, or at least put out something myself. And, one of the things, I wouldn't say it's not a trend, but it's certainly something that I think is really impactful and speaks to everything that's already been articulated. But in 2020, obviously with COVID, George Floyd, there was an opportunity for a range of foundations to innovate in different ways, and a number did. But one of the things that I really admire and continue to think of as something to kind of uplift and emphasize, because it doesn't seem as though a lot of people even realize they did this, but the Bush Foundation in Minnesota and Minneapolis, not related to the political dynasty, but the Bush Foundation in 2020 issued social bonds that they raised $100 million, which is about 10%, relative 10% of their endowment. And they took that $100 million and made $50 million grants into an indigenous-led entity focused on indigenous issues and a black-led entity focused on black issues within the regions in which the foundation prioritizes. And I bring this up because it was their idea to sort of distribute, leverage their balance sheet and assets to actually make direct endowment-like investment opportunities available to indigenous and black communities. And it's one of those innovations that some other foundations have done at smaller scale, but it's just a recognition, particularly for institutions, about how you can actually leverage your assets in completely different ways outside of the normal sort of investment framework and capacity. How you actually, I would oftentimes say, how can you create not only a foundation of perpetuity, but how can you create community wealth that's perpetual for communities as well? Like, how can you do both? So I want to uplift that as a innovation that I continue to admire. Laura, you actually mentioned this, but I want to go to this question since you already kicked it off. What are examples of collaborations between foundations for catalytic capital and knowledge sharing?
You want me to start, or?
Well, I mean,
Sure, I'm happy to. Well, I mean, I actually think Morgan has already given us a bunch of really interesting examples, and certainly I've seen it in my past, and I've seen it at DRK. But this idea of a capital stack and building a capital stack for impactful organizations or funds, you've seen in a lot of contexts. Prime Coalition, which is a climate-oriented organization in Cambridge, Mass, does a really good job of this as well. But how do you weave different types of capital that has different goals, incentives, sources, or frameworks around it? How do you weave that together to create effective and to fund organizations effectively? And I actually think Morgan's given great examples of that, so I'm not sure I have much to add.
I won't add another example, but I was going to say, in terms of principles for foundations collaborating, I think what's been most critical is people just being okay with being really direct about what your needs are, whether it's that we have a geographic restriction that we need to be cautious about, that we can accept a certain rate of return or range of rate of return, or we're okay with 5 years but not 7 because we're a spend down, or there can be any number of reasons. And I think sometimes people are shy in feeling like they need to justify or of why they might have a certain restriction. I think as long as we know that it's there, we can be creative in creating a capital stack that's going to work for people in terms of blended finance. And that when we've seen that type of open communication, then I think we're able to really get to the best outcomes for everybody. But that there's so much flexibility in how you do it.
I was going to add that we are part of Singapore's Sustainable Finance Association. They are really building out a white paper, presenting at COP with respect to blended finance, and perhaps creating a blueprint for blended finance transactions, making it easier. And there's conversations whether they could create a secretariat around these non-infra type of blended finance structures, which make it, you're not 100% of the way there because these projects will need to be tweaked, but you're almost 30 to 40% of the way there, where some of the legal ramifications have been covered, some of the structures have been looked at, so that it's easy for people to come along and say, perhaps if there's a project coming up, could AVPN play a role with the philanthropic side? Could credit investors come along? So the structures are easier to implement upon. And I think it's important then when we start looking at this, and we as an organization, we do similar events on knowledge sharing, we create case studies, we write research reports, and we're happy to share them. I mean, a lot of it's open source anyway. And I think that knowledge sharing is key part of this ecosystem building that we need to do to bring more capital to address the gaps that we have with respect to the SDGs right now.
Can I add one example you just triggered for me too? During New York Climate Week, the MacArthur Foundation and others convened a group of recipients of GGRF money, which is Greenhouse Gas Reduction Fund. So massive amounts of federal money in the US now supporting the energy transition, especially around just transition and bringing it into low-income communities. And because it's federal dollars, and anyone who's worked with federal dollars here, is at least in the US, it comes with so much regulation, and like, you can use it for this, but you can't use it for that, and you have to buy American, and you have to do that. And so, but basically the MacArthur Foundation and a group of other funders got a bunch of recipients of this federal money, very large sums, on one side of the table, and on the other side of the table, philanthropy, so that a bunch of different types of philanthropy, foundations, some climate investors as well, to hear from the folks that were receiving this $1 billion, $2 billion, $3 billion, what they were allowed to use it for, and where the gaps were. So in other words, you can use it for the projects, but you can't actually use it to support your team that you need to design the project, right? And I'm oversimplifying. But anyway, so that was, I think, a really good example of a role that philanthropy can play to, even around existing funding, to kind of identify gaps and opportunities for each other, and then again, let the right capital find the right opportunity at the right time.
So speaking of that importance of signaling to others, I did want to lift up how critical that signaling is, and that's something that I think that Draper Richards Kaplan is phenomenal at doing, right? That people know that that's a mark of excellency in philanthropy early stage, and I wouldn't say it if it wasn't true, but that means, we see that as investors, and that gives something that people can hold up, similar to Echoing Green or other organizations, and that sometimes we don't want to kind of overly feature, what we do, and the idea that anonymity has its own virtue. But there's other times where being too quiet does not help that entrepreneur. All right, so the degree to which you have a brand, a 22-year brand, and are able to leverage that for someone who's newer, that's a phenomenal service and is really important. And then it goes back to those sorts of introductions and how critical they are. I guess 5 years ago now, came out with a book called Real Impact on impact investing. And most people, you're supposed to dedicate your first book to your mom, right? And I dedicated it to my first grant maker, a woman named Janet Shank from the Ponte Foundation at the time, because her support of me in taking me around to other grant makers when I was a little 23-year-old who didn't know anything was life transforming. Absolutely life transforming. That $285 million that we've allocated would not have happened without that grant maker. And I think that's where, Janet owned her power in that as someone who'd been a force in philanthropy for many years and was able to walk me around the rooms of power. So if you are someone who navigates rooms of power well, if you can grab someone by the hand and have them walk with you, that's another really important component to catalytic philanthropy.
Yeah. So Mark's been skulking back there, trying to bring me off stage anyway, but I'm gonna give you 2 seconds, Mark. You know what? Yeah, I know it's misleading. It's misleading. One thing I did want to say before I send us off, but I did want to answer this as well, because one of the things that, given the topic itself, one example I look to is also the Community Investment Guarantee Pool, which is an actual collaboration between funders, and I to utilize guarantees as a means to effectively get capital off the sidelines and sort of de-risk opportunities, which I think is a very catalytic opportunity. So I would just offer that as well. And by the way, guarantees are a really powerful way to be catalytic, I think, as well.
Kresge's done a great job there as well, the Kresge Foundation.
Robert Wood Johnson Foundation, CZI has been a part of that effort. A number of funders, and particularly because it's an opportunity if you're a smaller foundation, where you can sort of manage things a bit differently if you can't actually commit upfront capital, because it's really de-risking for you as well. So I think that's just in terms of something, a tool in a toolbox, I should say, that I think is underutilized more generally. Having said that, Mark, we're getting off stage, don't worry. I want to just thank our panel. Morgan, Lara, Como, the work that you do is actually the most important thing, but the fact that you're spending time in spaces like this to educate and inform and connect ideas and action is very, I don't want to underestimate and undervalue that. It's significant, so I want to thank you for that.